What if the very system designed to control silver prices is now creating the biggest silver breakout in years? Welcome back to Pulse of Silver, the channel where we break down the biggest stories shaping the silver market, global finance, and the future of precious metals. Today's story is one that has silver investors all over the world paying very close attention, because what just happened at the COMEX may have started something far bigger than most people realize. At first glance, it looked like another normal market move. Another attempt to cool down silver momentum. Another effort to keep prices under control. But many analysts now believe this move could backfire badly. And if they are right, silver could be entering one of the most important moments in modern market history. To understand why this matters, we first need to understand what the COMEX really is. The COMEX, which is part of the Chicago Mercantile Exchange, is one of the world's largest futures markets for precious metals like gold and silver. This is where massive contracts are traded every single day. Most of the silver traded there is not physical silver moving from one vault to another. Instead, it is paper silver, contracts representing silver that may never actually be delivered. For years, critics of the system have argued that this paper market has allowed large financial institutions to heavily influence silver prices. Every time silver starts gaining strong momentum, huge waves of paper contracts often appear, pushing prices back down. And recently, something happened that caught the attention of experienced silver traders. COMEX inventories began shifting in unusual ways. At the same time, pressure in the physical silver market continued growing. Industrial demand remains strong because silver is needed in solar panels, electric vehicles, military technology, medical devices, and advanced electronics. But while physical demand rises, many investors are asking an important question. What happens if too many people suddenly demand actual delivery instead of paper contracts? This is where things become interesting. Reports of declining available silver inventories have started raising concerns among market watchers. Some analysts believe the COMEX may be trying to manage rising pressure by changing trading conditions and influencing market behavior through futures activity. The goal may be simple: calm the market before silver prices rise too fast. But history shows that attempts to suppress strong demand can sometimes create the opposite effect. When investors sense fear or weakness inside the system, they often rush toward physical assets even faster. That is exactly why many silver investors believe the current situation could backfire. Instead of scaring investors away from silver, the recent market actions may actually be increasing interest in physical ownership. More people are beginning to ask whether the paper silver market is truly backed by enough real metal. And once confidence starts breaking down, markets can move very quickly. What makes silver different from many other assets is that it sits between two powerful worlds. It is both a precious metal and an industrial metal. During times of economic uncertainty, investors buy silver as protection against inflation and currency weakness. But at the same time, global industries depend on silver for production. That combination creates a unique pressure point. If investment demand and industrial demand rise together, supply can tighten very fast. And right now, many signs suggest exactly that may be happening. Central banks continue printing money. Government debt keeps rising. Inflation fears are not fully gone. Geopolitical tensions continue affecting global markets. In this environment, investors naturally begin looking for hard assets. Gold usually gets attention first. But historically, silver often follows later with much more explosive moves. The big question now is whether COMEX actions are slowing silver down temporarily or accidentally preparing the market for a much larger rally later. Because if confidence in paper silver weakens while physical demand keeps growing, the result could be something the market has not seen in a very long time. And for silver investors, this story may only be getting started. One of the biggest reasons analysts believe the COMEX situation could backfire is because the physical silver market is becoming harder to ignore. For many years, paper trading dominated price discovery. Massive futures contracts could move silver prices in minutes, even though very little physical metal actually changed hands. But today, something different is happening beneath the surface. Physical silver demand is becoming stronger, broader, and far more global than many expected. The world is changing rapidly, and silver sits right at the center of that transformation. Governments around the world are pushing for green energy projects, electric vehicles, solar expansion, and advanced technologies. Almost all of these industries require silver. Solar panels alone consume enormous amounts of the metal because silver is one of the best conductors of electricity in the world. Electric vehicles use far more silver than traditional cars. Artificial intelligence systems, semiconductor manufacturing, medical technology, and military equipment also depend heavily on silver components. This creates a serious long-term challenge for supply. Unlike gold, much of the silver used in industry is difficult or expensive to recycle. Once silver is used in tiny industrial applications, much of it disappears from the market permanently. That means growing industrial demand slowly reduces available above-ground supply over time. At the same time, new silver mining projects are becoming harder to develop. Mining costs continue rising, environmental regulations are becoming stricter, and high-grade silver discoveries are becoming less common. Now combine that industrial pressure with growing investor demand. Around the world, more people are questioning the stability of the financial system. Inflation may have cooled from its peak in some countries, but prices remain far higher than they were just a few years ago. Many families feel that their money buys less every month. Trust in banks, governments, and central banks has weakened. And during periods like this, precious metals often attract attention. Silver is especially attractive because it remains far cheaper than gold on a per-ounce basis. Many retail investors who cannot afford large amounts of gold often turn to silver instead. That growing demand for coins and bars has already created shortages at different times over the last few years. Premiums on physical silver products have occasionally surged far above the official spot price, showing a disconnect between paper silver prices and real-world physical demand. This is where the COMEX situation becomes dangerous for the system itself. If enough investors begin losing confidence in paper contracts, they may increasingly choose physical delivery or direct ownership instead. That creates stress because the paper market is many times larger than the amount of physical silver actually available. In normal conditions, most traders settle contracts in cash rather than demanding metal. But if behavior changes, the balance can shift quickly. Some analysts compare this risk to a bank run. A bank can operate normally as long as most depositors leave their money in place. But if too many people suddenly demand cash at the same time, problems appear immediately. The silver market operates with similar psychology. As long as confidence exists, paper contracts function smoothly. But once confidence weakens, demand for real metal can accelerate fast. That is why recent COMEX actions may end up creating more attention instead of less. Attempts to cool silver enthusiasm sometimes make investors even more suspicious. Social media, independent analysts, and precious metals communities are spreading awareness faster than ever before. Information that once stayed hidden inside financial circles is now discussed openly online every day. And perhaps most importantly, younger investors are entering the precious metals market with a completely different mindset. Many no longer fully trust traditional financial institutions after witnessing inflation, banking stress, rising debt, and economic instability. To them, physical silver represents independence and protection. It represents something real in a world increasingly built on digital numbers and financial promises. If that mindset continues growing, the pressure on physical silver markets could become very difficult to contain. And if COMEX actions accidentally strengthen that movement, the consequences for silver prices may be far larger than most mainstream analysts currently expect. For years, silver investors have talked about the possibility of a massive silver short squeeze. Many believed it would never happen because large financial institutions appeared too powerful and too well connected. But recent market behavior has caused that conversation to return in a serious way. And now, after the latest COMEX developments, some analysts believe the conditions for a powerful silver squeeze may slowly be forming again. To understand this, we need to look at how short selling works in the silver market. A short position is essentially a bet that silver prices will fall. Traders borrow contracts and sell them, hoping to buy them back later at lower prices. This strategy becomes extremely profitable if prices decline. But if silver suddenly rises sharply, short sellers can face huge losses very quickly. In that situation, they often rush to buy contracts back to limit damage. That wave of buying can push prices even higher, creating a chain reaction known as a short squeeze. Silver has always been considered one of the most heavily shorted commodities in the world. Critics argue that large institutions have used enormous paper positions to suppress price rallies for decades. Whether every accusation is true or not, one thing is clear: silver markets are highly leveraged. The amount of paper silver traded is far larger than the physical supply available. That creates vulnerability during periods of strong physical demand. What makes today different is the growing disconnect between paper market behavior and physical market reality. Normally, futures markets help balance supply and demand efficiently. But when physical shortages begin appearing while paper prices remain under pressure, investors start asking difficult questions. If silver is truly abundant, why do delivery delays and rising premiums appear so often during demand spikes? Why do inventories become such a major focus every time silver rallies? Recent movements inside COMEX vaults have added fuel to these concerns. While silver still exists within the system, many analysts are paying attention to how much of that silver is truly available for delivery. There's a major difference between total silver stored in vaults and silver that is actually ready to satisfy contract delivery demands. If available inventories tighten too much while demand increases, market stress can rise quickly. This is why some silver investors believe recent efforts to manage prices could eventually fail. Artificial pressure can work temporarily, but if underlying demand continues strengthening, eventually the market may overwhelm attempts at control. History shows that markets can stay calm for long periods, until suddenly they are not. And when sentiment shifts, price movements can become violent. A silver squeeze would not necessarily happen overnight. In fact, it could unfold in stages. First, physical demand slowly tightens supply. Then confidence in paper markets weakens. After that, more investors seek direct ownership. As prices begin rising, short sellers face increasing pressure. Momentum traders join the move. Media attention grows. Retail investors rush in. And suddenly, a market that was ignored for years becomes one of the hottest trades in the world. We have seen similar patterns before in other assets. Markets often remain quiet and controlled until a breaking point appears. Once that point is reached, price discovery changes completely. Instead of asking how low prices can go, traders suddenly ask how high they can rise. Silver is especially dangerous for short sellers because the market is relatively small compared to global financial markets. It does not take the same amount of capital required to move stocks or major currencies. Strong investment demand combined with industrial pressure can create very sharp price swings. And perhaps the most important factor is psychology. Financial markets run on confidence. The moment traders believe a squeeze is possible, behavior changes rapidly. Fear spreads among short positions. Excitement spreads among buyers. Volatility increases. That emotional shift alone can accelerate momentum. This is why so many investors are watching the COMEX closely right now. Because if recent actions fail to calm the market and instead increase concerns about physical supply, the silver market could eventually react in a way very few people are prepared for. The world economy is entering a period of uncertainty unlike anything seen in decades. Debt levels are exploding across major nations. Governments continue spending enormous amounts of money. Central banks remain trapped between fighting inflation and protecting economic growth. And at the same time, global tensions are rising politically, economically, and militarily. In environments like this, investors begin searching for assets that can survive instability. That is one reason why silver may become one of the most important assets of this decade. For years, silver remained overlooked by mainstream investors. Technology stocks dominated headlines. Cryptocurrencies captured attention. Real estate prices surged in many countries. Precious metals often seem forgotten. But cycles in financial markets always change eventually. When confidence in growth assets weakens, investors typically move toward hard assets with long histories of preserving value. Gold has traditionally been the first destination, but silver often follows with even stronger percentage gains. What makes silver unique is that it benefits from both fear and growth. During economic uncertainty, investors buy silver as protection against inflation, currency weakness, and financial instability. But unlike gold, silver also benefits when industrial production expands. It is critical for clean energy systems, electronics, medical equipment, artificial intelligence infrastructure, and modern defense technologies. That combination creates an interesting possibility. Even if global economies slow down temporarily, governments are still likely to continue funding strategic industries tied to energy, military security, and advanced technology. All of those sectors require silver. This means demand may remain strong even during difficult economic conditions. At the same time, silver supply growth is struggling to keep pace. Many silver mines are actually byproducts of other mining operations such as copper or zinc production. That means silver output cannot always quickly increase simply because silver prices rise. Building new mining projects takes years, sometimes decades. Environmental approvals, financing problems, labor shortages, and political risks continue slowing development around the world. This supply-demand imbalance is why many analysts believe silver remains fundamentally undervalued. Some investors point to the gold-to-silver ratio as evidence. Historically, silver often traded at much higher relative values compared to gold than it does today. If silver eventually returns closer to historical relationships, prices could rise significantly from current levels. Now add the COMEX situation into this larger picture. If investors increasingly believe the paper market no longer reflects real physical conditions, silver could experience a major repricing event. Markets are built on trust. Once trust weakens, price adjustments can happen very fast. Another important factor is the growing global shift away from complete dependence on the US dollar. Several countries are exploring alternative trade systems and increasing gold reserves. While silver is not officially treated the same way as gold by central banks, rising interest in hard assets generally supports the entire precious metals sector. If confidence in fiat currencies continues weakening globally, silver could attract a new generation of investors seeking protection outside traditional financial systems. Retail investors are also becoming more educated than ever before. Thanks to online communities, podcasts, independent analysts, and financial media outside the mainstream system, people now have access to information that was once difficult to find. Many younger investors understand inflation risks and debt problems far earlier than previous generations did. And because silver remains relatively affordable, it becomes an accessible entry point into precious metals ownership. All of this creates a powerful setup. Rising industrial demand, tightening physical supply, growing distrust in paper markets, increasing economic uncertainty, expanding investor awareness. These forces are now colliding at the same time. That does not guarantee silver prices will move straight upward tomorrow. Markets remain volatile and unpredictable. But what it does suggest is that silver may be entering a period where small changes in confidence or supply conditions could create very large price reactions. And if recent COMEX actions unintentionally increase investor suspicion instead of calming the market, silver's next move could surprise almost everyone. The silver market is no longer just a small niche discussion among precious metals enthusiasts. Silver is now connected to some of the most important economic and technological trends in the world. It sits at the center of industrial demand, monetary uncertainty, energy transformation, and growing distrust in traditional financial systems. And because of that, every major move inside the COMEX is now receiving far more attention than it did in the past. The recent actions surrounding silver trading may have been designed to reduce pressure, slow momentum, or calm speculation. But markets do not always react the way institutions expect. Sometimes efforts to control a narrative actually increase public interest. Sometimes attempts to suppress volatility create even larger moves later. And that is exactly why so many analysts believe the COMEX situation could eventually backfire. The biggest issue is confidence. As long as investors trust the paper-silver system, the market can continue functioning normally. But once large numbers of people begin questioning whether paper contracts truly represent available physical metal, behavior starts changing. Investors move toward direct ownership. Physical demand increases. Premiums rise. Delivery concerns grow louder, and slowly, the entire structure begins facing more pressure. What makes this moment especially important is that silver fundamentals already appear strong without any market stress. Industrial demand continues expanding rapidly. Supply growth remains limited. Inflation concerns still exist globally. Government debt levels continue climbing. Central banks remain under pressure. These forces alone create a supportive environment for precious metals. But if concerns around the paper-silver market increase on top of those fundamentals, the impact could become much larger. At the same time, it is important to remain realistic and disciplined. Silver is known for volatility. Prices can move sharply in both directions. Emotional trading often leads investors into bad decisions. Markets rarely move in straight lines, and timing major breakouts is extremely difficult. That is why experienced investors focus on long-term trends rather than short-term headlines. Still, history shows that markets often change direction when the majority least expects it. Before major rallies begin, assets are usually ignored, doubted, or heavily controlled. Then gradually sentiment shifts. More investors begin paying attention. Physical demand tightens supply. Confidence changes. And eventually the market enters an entirely new phase. Whether this becomes that moment for silver remains to be seen. But one thing is certain, the pressure building beneath the surface is becoming harder to ignore. And if the COMEX actions meant to contain silver enthusiasm instead encourage more investors to seek physical ownership, the consequences may extend far beyond what most financial institutions currently anticipate. For silver investors around the world, the coming months could be extremely important. The market may continue facing volatility, manipulation claims, and sudden price swings. But underneath all the noise, the long-term story of silver appears stronger than ever. And if physical demand keeps rising while confidence in paper systems weakens, the next chapter in silver's history could become one of the most dramatic yet. Thank you for watching Pulse of Silver. If you enjoyed this breakdown, make sure to subscribe, turn on notifications, and stay with us for more updates on silver, gold, economic shifts, and the future of the global financial system. A quick disclaimer before we end this video. This content is created for educational and entertainment purposes only. Nothing in this video should be considered financial advice, investment advice, or trading advice. Markets involve risk, and silver prices can be highly volatile. Always do your own research and speak with a qualified financial professional before making any investment decisions.